high income covered call ETFs. What are they? Should you consider them? What are the pros and cons? Where would they fit into your investment portfolio? This is a question I've been getting a lot of recently with my wealth builders in our monthly and our calls and our market mashup, because these new products are coming out so often. In the investment houses bring those out and they can sound sexy, and should we use them? So I've been using some high income covered call ETFs to experiment with them to see what their impact is on the portfolio. And I wanted to share a bit about them. So remember, first off, we love exchange traded funds. Essentially, your common vanilla normal exchange traded fund is essentially an index tracker fund, which is just bought and sold the units of either stock market. Now, at its core, we are index tracker investors. We know that trying to time the market, trying to stock pick are all strategies that are going to pretty much guarantee we're going to underperform. Whereas we can use these fantastic index tracker vehicles to get above market returns. So I'm not going to go any deeper into index trackers in this video because there are other videos available for that, and I'll put the link in the description. Now, of an index tracker, you can invest in index trackers in your portfolio in the form of an exchange traded fund, an ETF, or a unit trust mutual fund version. Same things, they're both bananas, they just come in different packages. Again, understanding the difference between a mutual fund, a unit trust fund, and an exchange traded fund covered in a different video. So again, we'll put that in the comments below. But what is important here is now we're going to be looking at high income covered call ETFs. And so these are managed funds that have been put together by fund houses and offered in the form of an exchange traded fund. So you can buy shares of this fund in your portfolio, your tax deferred and your tax free via your online broker into your investment portfolio. But they are actually actively managed because they're going to be a bundle of shares and stocks that are selected by a team who actively then use option strategies, often covered calls, to generate income on that portfolio to try and get higher income. And so a covered call ETF means covered calls is an option strategy where these options are used to generate income, where essentially people have an option to buy that and to share out of the fund, and there's income generated from these option contracts. So don't worry, you don't have to understand the ins and outs of options in detail, but it's a way to generate basically rental income for use, an option for other people to buy that, and it's a way you can generate income. Now you can do your own options trading, and we cover some of that in Wealth Builders membership. But essentially, in these exchange traded funds, a fund house holds a bundle of shares, and then it writes these and sells these covered calls on the holdings of that portfolio inside that fund to generate this income. Now, those holdings might be an index. It might be the S&P 500. It might be the NASDAQ. It might be the All World Index. And then these options are written on top of it. It might be a specific portfolio that options are written on top of it. And so these are bought and sold with the intention of generating income. And so the theory is that the premiums received, the premium is the income you get from writing and selling these call options, are passed through the investor and then distributed as that income. And so this often leads to a higher yield. Remember, yield is the income generated from your holdings, similar like you get rental yield. Well, this would be yield from the holdings that you have as a shareholder in that ETF. So generally, these are significantly higher yields than you would get from purely the dividend distribution, where companies issue and distribute their profits in the form of dividends, and then you as a shareholder through shares in that fund get those dividends. So now the key point here is you're generating income through an active covered call strategy that is done by the management of that fund versus a passive index tracker strategy where you're also receiving income from the dividends directly from the underlying holdings. You might also get the dividends distributed, but the primary income strategy is from this active trading side. So let's understand the advantages, the pros and cons of having these. These can be a great option to add into your portfolio to bring you some higher and more regular income. When you're at the stage in your portfolio where you're looking for higher drawdown, where you're looking to get higher yields or income from that portfolio to start feeding off it, you can get, and sometimes these yields are double digits, making them very attractive in low interest rate environments and where you're wanting income for your portfolio. So higher regular income. And this is really important because a lot of people say, well, Anne, why wouldn't I want income the whole time? Surely I want that. You only want to consider adding these higher income generating type of vehicles into a portfolio where you're at or near your financial freedom number, where you've got enough assets that you're ready to start feeding on them. Because when you're in your net accumulation phase, you're growing, you're directing your actively earned income into your paying yourself first, you're growing your financial freedom. Adding income generating investments into your portfolio that you're also going to feed off. One is robbing yourself too soon. You should be reinvesting any investment returns, whether they're dividends, whether there's rental yields, whether there's yields from things like covered calls. But the challenge is if you're investing in these outside of a tax protected environment, it's going to add to your taxable income. So you're likely to get higher tax. So I'm jumping ahead in terms of the pros, but this is really important to understand why you only want to be considering using these at a certain stage on your wealth journey. Now, the second pro on this, it really does give you income stability in that you can get a pretty good sense of the yield that you would get from these covered calls. And if a market declines or there's a partial downside market going nowhere, it gives you a bit of a buffer in your portfolio by having this income in. And in sideways, or what are called bear markets, down markets, these covered call ETFs often outperform other just what are called long only equity strategies. So long only means they held those underlying investments are held by that fund. And this is because of this income cushion that comes in. So you've got more income and you're not relying just on dividends and the price movement of that stock. It's also a very easy way to implement an income strategy using options into your portfolio without you having to be the one actually writing those covered calls, doing those covered call strategies. Now, you can do those, but that's far more active, far more complex. You're taking that risk. In this way, using a covered call high income ETF, you've got a hands-off way to access that more complex income generating tactic into your portfolio in quite a nice passive way. And obviously it also adds to diversification to a bigger portfolio because now you're going to have your broad-based index trackers that form the bulk of your investment pyramid. You might have some conviction stocks that you've added in. You might have a few little speculative things, but by adding a small percentage of high yield covered call ETFs in, you can add another strategy in that will bring you another income generation approach, specifically when you're heading towards that drawdown feasting or phase. But there are some drawbacks you really need to be aware of. The important drawback is there often is a capped capital side. So remember, any asset you get a return from both the capital growth, the value of the underlying investment growing, and the income generated. Now, in these high income covered call ETFs, they give up what's called the upside price movement, that capital growth side, especially in strong bull markets. When the market is going up, prices are rocking and roaring because what is called the strike price, the price at which a call option is exercised, hits before you can benefit from that upside. And so you are trading off capital growth, upside price movement for income. And that's really important to understand. And this is why, again, I say if you're in a wealth accumulating stage where growing your capital base is your priority through your own investing in paying yourself first and getting your assets working, and you're not feeding off them, rather just let the price run move and take that upside growth, accept the volatility. But if you're wanting income, you accept that you're going to have some capped or limited upside on the capital side because you're trading that off for more income. And so understanding the different nature of these is super important. And so generally over the longer term, these kind of instruments, a high income covered call kind of ETF is going to have a longer term underperformance compared to just sticking your investments in a broad basket of index trackers because of this upside limiting that the covered call strategy does. So again, useful for a period, for a portion of your portfolio to increase some income if that's what you're wanting, but the overall portfolio, you'd never want to put all of your assets into that. They also, because they're actively managed, have higher expenses and more complexity in it. And so you've got actively management layers that add complexity, additional trading costs. So you're going to have higher fees. Remember, we want to keep the costs down. So if you're going to use these, you understand the implication of those higher fees and you make that conscious choice. You don't just go after it because it sounds like the flavor of the month and woohoo, because, it gives you income. That's not the option. And remember, because it's deemed as a trading activity, there's this option trading, and any trading activity is often taxed as trading income or short-term, what's called ordinary income, rather than qualified dividend income. Now, dividends are taxed at a lower rate than ordinary income. And so if you're investing in these outside of a tax-free or a tax-protected environment, like your pension, your retirement, your superannuation, your ISA, your tax-free savings account, something where you've got some tax protection, you're going to be paying for these returns at your highest marginal tax rate. So again, how much are you going to lose from that? And so if you're a high income tax earner, make sure if you're going to do these, put them in the most tax efficient bucket that you can. So the pros: potential high income yield, great for stability of income if that and if drawdown is your priority. Cons: you're going to limit your upside potential and the price of the underlying units, especially in a bull market, can underperform over the long term because of that, and high tax consequences if it's outside of any tax protected environment. So there you go. High income covered call ETFs, pros and cons, and hopefully that's given you some information to chew on to decide when you should use them, if you should use them at all, and knowing that, remember, the most important thing is consistent regular investing in a simple broad market index tracker funds in the most tax efficient way. This is how you build up your wealth, and these slightly more complex, fancy things that you might be useful, but only really when you're in the drawdown stage, when you're ready to start feasting off these, and you do them with knowledge and information. And so click on some of those other links if you're needing to dive into what are index trackers, how to build that broad market portfolio, what's the difference between an ETF and a unit trust or mutual fund, and join the Wealth Builder Club, where we go deep into all of this stuff. We have regular Q&As and there's lots of training for you to really get your money working hard for you.